$72, 75, 80, 72 again, 80 again. Silver is bouncing off the same levels like a tennis ball on concrete. And if you're wondering why it won't break lower, I'm about to show you exactly who's defending that floor. Mark here from GoFinance. And I need you to step back from the 1-minute chart and look at the horizon. Because while retail traders are hyperventilating about paper dips, the smartest money in the room is quietly positioning for a vertical move that will reshape the global financial system. It's February 11th, 2026. Gold is holding at 5,050. Silver is fighting between 72 and 80. And while you're worried about the floor falling out, institutional analysts are looking at the ceiling and realizing the ceiling is much, much higher than anyone dares to admit. We need to talk about Merkin Capital. We need to talk about Daniel Oliver. He's one of the few analysts who understands the historical mechanics of a currency collapse. And he just released a thesis that makes the current price of gold look like a rounding error. He isn't calling for 6,000. He isn't calling for 7,000. He's arguing that the correct price, the mathematical equilibrium price required to save the system, is between $8,395 and $12,595 per ounce. Here's the math that CNBC anchors won't show you. Historically, whenever a fiat currency system reaches the breaking point, whenever debt becomes unpayable and confidence evaporates, the central bank is forced to restore credibility. How? They back their liabilities with hard assets. They don't have to back 100% of the money supply. That's a fantasy. But history shows that to stop a hyperinflationary spiral, they must back between 33 and 50% of the central bank's balance sheet with gold. Look at the Federal Reserve's balance sheet today. Trillions of dollars of printed money. Reverse repo liabilities. Bank reserves. If you take that pile of paper and require 33% gold backing, gold must reprice to 8,000. If you require 50% backing, which is what happened in previous crises, gold goes to 12,000. This isn't speculation. This is division. Total liabilities divided by gold ounces equals 12,000. Subscribe to GoFinance if you haven't already. Drop a comment and tell me, do you think the Fed will actually revalue gold to save themselves, or will they let the system collapse? I read every single comment. Now let me show you why this has to happen in 2026, because of the Fed trap. This is the secret that Kevin Warsh, the man Trump just nominated to run the Fed, is desperately trying to hide. The Federal Reserve is currently insolvent. They're losing money. Specifically, they're suffering operating losses of roughly $245 billion per year. Why? Because they printed trillions to bail out banks, and now they have to pay 5% interest on those reserves to keep inflation from exploding. But their assets, the treasury bonds they bought years ago, are only paying 2%. They're paying out 5 and earning 2. They're bleeding $250 billion of equity every single year. This is the death spiral. Kevin Warsh can't fix this with a rate hike. If he raises rates to kill inflation, the Fed's losses explode and the U.S. Treasury goes bankrupt paying interest on the national debt. If he cuts rates to save the Treasury, inflation goes vertical and the bond market collapses. He's trapped. There's only one exit door, only one way to recapitalize the Fed without printing more worthless paper. Revaluation. You take the gold in Fort Knox, you mark it up from the fake official price of $42 an ounce to the market price of $12,000 an ounce. Instantly, the Fed's balance sheet is healed. The Treasury is solvent. The debt is manageable, but the dollar is devalued by 90% against real assets. So when you see gold at 5,050, realize it's still trading at a 50% discount to its utility value. The crash to $80 silver and $5,000 gold wasn't the end of the bull market. It was the final shakeout before the revaluation event. The institutions know this. That's why they're buying. But who was selling? Who was crazy enough to dump billions of dollars of paper gold and silver into this market? We found him. About 75% of you watching aren't subscribed. If this breakdown is connecting dots you've never seen before, hit subscribe. Drop a comment and tell us, have you heard of Bian Ximing before this video? Now let me expose the whale. It wasn't the Chinese government. It wasn't the Illuminati. It was one man. We need to talk about Bian Ximing. You've probably never heard his name. The media doesn't talk about him. He's a ghost. He's a Chinese billionaire trader who operates not out of Shanghai or Beijing, but out of a nondescript office in Gibraltar. He's the Chinese Soros, and he's currently holding the single largest short position in the history of the silver market. We've identified a net short position of approximately 30,000 contracts. That's equivalent to 450 tons of physical silver. 450 tons. Now you need to understand why he's doing this. This is not political. This is purely mathematical. Bian Ximing is not betting against silver because he hates the metal. He's betting on a spread trade. He's betting on the gold to silver ratio widening. Our intelligence indicates he's been long gold since 2022. He made over $3 billion riding gold from 2,000 to 5,000. He's a bull. He believes in the collapse of the dollar. But he believes gold is the monetary king and silver is just an industrial peasant. So his strategy is simple but deadly. He's long gold and short silver. He's using the profits from his massive gold position to fund a massive silver short. He's betting that as a global recession hits, industrial demand for silver will crash while monetary demand for gold will soar. He's betting the ratio will blow out to 100 to 1. And for the last 2 weeks, he's been right. The Warsh crash played right into his hands. The paper price of silver collapsed from 121 to 72. On paper, right now, BN is up roughly $288 million on this specific trade. This completely debunks the China wants cheap silver theory. The Chinese government isn't suppressing the price to fill its vaults. A rogue billionaire is suppressing the price to hedge his gold bet. There's a massive difference. A government has infinite money and can suppress price forever. A trader has a margin limit. A trader can be squeezed. A trader can bleed. And this is where the opportunity lies for you. BN Keiming is currently sitting on a mountain of dynamite. He's sold 450 tons of silver that he does not have. He's naked short. He's betting he can buy it back cheaper later. But what happens if he's wrong? What happens if industrial demand doesn't crash? What happens if Turkey keeps buying record amounts? What happens if the price ticks back up to 86? Then BN Keiming stops being the hammer and starts being the nail. He'll be forced to cover. He'll have to buy back 30,000 contracts in a market that has no physical metal left. This is the classic setup for a short squeeze. The price isn't down because of supply and demand. It's down because one whale dumped a massive paper order. But paper orders are temporary. Physical shortages are permanent. And while BN is celebrating his $288 million paper profit in Gibraltar, the physical market is moving against him. The vaults are draining. The trap is set. And the biggest buyer in the world just stepped into the ring to take the other side of BN's trade. We need to talk about Turkey. We need to talk about the 8.79 million ounces that just vanished from the market. Here's the twist. BN Keiming thinks he's the hunter. But in reality, he just volunteered to be the prey. He's currently celebrating a $288 million paper profit. He thinks he cornered the market. But what he actually did is paint a giant target on his back for every bull in the world. Let's look at the physics of his position. He's short 30,000 contracts. That represents 450 tons of silver, roughly 14.5 million ounces. Now ask yourself a simple question. Does BN Keiming have 450 tons of physical silver sitting in a warehouse in Gibraltar? No, he's naked short. He sold a promise. He sold paper. He's betting he can buy the contracts back cheaper before the delivery date. This is where the math turns against him. Right now, price is hovering around 72 to 80. He's in the money. But what happens if price ticks back up to 86? What happens if dip buyers step in? Suddenly, his 288 million profit evaporates. And then the margin call comes. The exchange will call him and say, Mr. BN, you're underwater. Post more collateral or close the position. And to close a short position, you have to buy. Now, let me show you the buyer that's about to destroy his trade. While BN Keiming is selling paper in Shanghai, a massive vacuum cleaner just turned on in the Middle East. One country just bought 8.79 million ounces in a single month. They effectively bought half of BN's position in physical bars. Taking it off the table forever, we need to talk about the Turkey floor. If you want to know why silver is bouncing off the $72 and $80 levels like a tennis ball on concrete, look at the import data that just crossed the wire. In the month of January alone, while Western media was screaming about deflation and Kevin Warsh, Turkey quietly backed up the truck. They imported 273.3 tons of physical silver. Let me translate that into ounces so you can comprehend the scale of the drain. That's approximately 8.79 million ounces of silver in 31 days. This is not a slight increase in demand. This is an all-time record. This is a nation-state deciding that fiat currency is dying and hard assets are the only lifeboat. You have to put this number into perspective. Global mine production is relatively flat. The easily accessible silver has already been dug out of the ground. And now one country, Turkey, is vacuuming up almost 9 million ounces in a single month. They're taking it off the market. They're putting it in vaults in Istanbul. They're using it for industry, for jewelry, but mostly they're using it as money. Because in Turkey, they know what hyperinflation looks like. They live it. They know that when currency collapses, the only thing that retains value is the metal. So when the bullion banks and BN Keiming pushed the price down to 80, Turkey didn't sell. They said, thank you for the discount. And they bought every ounce they could get their hands on. This is what we call a physical floor. A paper floor can be broken with more paper. You just print more contracts and short it down. But a physical floor is made of atoms. You can't short it. You have to supply it. And every time price touches 72 or 80, the Turks and the Indians and the private wealth funds step in and buy the physical metal, draining the inventory of COMEX and the LBMA. They're calling the bluff of the paper shorts. They're saying, if you want to sell it this cheap, we'll take delivery. And this demand shock is colliding with a massive supply shock, because while Turkey is vacuuming the floor, the ceiling just caved in. We have to remember the new geopolitical reality that took effect on January 1st, 2026. China instituted sweeping export controls. They officially locked down their domestic supply of critical minerals, including rare earths and base metals that often produce silver as a byproduct. China is no longer exporting its resources to the West. They're hoarding them for their own financial, military, and industrial needs. So the biggest producer and refiner in the world has essentially closed its doors to the global market. What does this mean for the supply chain? It means the Western pool of available silver is shrinking rapidly, the flow from the East has stopped, and the remaining inventory in the West is being drained by the Middle East and Asia at record speeds. COMEX vaults are bleeding. The LBMA is quietly terrified. Supply is restricted by Beijing. Demand is supercharged by Istanbul. This is the anvil and the hammer, and the paper price is caught in the middle. This proves the crash to 80 was an illusion. It was a temporary manipulation driven by speculation, not a reflection of physical reality. The physical reality is that silver is becoming harder to find, more expensive to mine, and highly sought after by nations preparing for a monetary reset. But even with this massive physical support, we have a tactical warning for the immediate future. We have a period of extreme danger coming up on the calendar. We need to talk about the Lunar New Year trap. And we need to look at what's going to happen next week when the Asian buyers go home. About 75% of you watching aren't subscribed. If this is the most detailed silver analysis you've seen, hit subscribe. Now let me show you the danger window. Even with Turkey buying every ounce in sight, we have to be realistic about the next 10 days. We have to look at the calendar and understand that the paper market is about to get very dangerous and very thin. We're entering a window of time that algorithmic traders love to exploit. We're entering the Lunar New Year trap. Next week, starting Monday, February 16th, the entire Asian continent goes on holiday. It's the Chinese Lunar New Year, Year of the Snake. The Shanghai Gold Exchange closes, Hong Kong banks close, Singapore slows to a crawl. Billions of dollars of daily liquidity vanish from the global order book. The physical bid, the constant buying pressure from the East that supports price, disappears for a full week. This creates a thin market, and in a thin market, the sharks come out to play. You need to understand the mechanics of this. When volume is low, it takes much less money to move price. If Bian Ximing wants to smash silver down to 72 on a normal day, he has to fight thousands of buyers in Shanghai. But next week, the buyers are gone. They're eating dumplings with their families. The order book is empty, so a relatively small sell order can cascade into a flash crash. The algorithms know this. They're programmed to hunt stop losses during holidays. They'll try to push price down to test your resolve. They'll try to break the $72 floor just to see if there are any buyers left in the West. So here's the forecast for the week of February 16th to 23rd. Expect extreme volatility coupled with low volume. We're likely to see a bearish spinning top candle on the weekly chart. A lot of movement, but very little actual progress. Price will likely drift lower, testing the resolve of the remaining bulls. The key level to watch is $72. This is the line in the sand. This is the technical floor where the last bounce started. If algorithms manage to push it below 72, we could see a quick flush down to the high 60s before buyers step back in. But if 72 holds, if we see price touch 72 and immediately spring back to 75, that's the signal. That tells you that even without China, the floor is concrete. It tells you that Western buyers, the Turks, the Americans, the Indians, are defending the line. But the psychological battleground is $80. 80 is the number everyone is watching. It's the Maginot Line for the bears. They need to keep it below 80 to maintain the crash narrative. If silver reclaims 80 next week, in the middle of a holiday with no Asian support, then the game is over. Then the bears are dead. Because it means the organic demand in the West is strong enough to overpower the manipulation on its own. So the play for next week is simple. Do not panic. Do not let the low volume drift scare you out of your position. This is a seasonal anomaly. It happens every year. The liquidity will return on February 24th. And when China comes back online, they'll see price at 72 or 75 and they'll treat it as a gift. They'll buy the dip with a vengeance. We could see a violent snapback bounce by the end of the month. We could see silver catapult from 72 back to 86 in a matter of 48 hours once the holiday ends. The spring is being coiled. The thin market is just compressing it further. So use this week to prepare. Use the volatility to your advantage. If they give you cheap silver, take it. But know that the crash to 80 was manufactured. It was artificial. And artificial prices don't last in a world of real shortages. Now let me wrap this up with the final verdict on the whale, the floor, and the future. We've connected the dots. We've seen the Merkin thesis that calls for gold to hit 12,000 just to balance the Fed's books. We've exposed the whale, Bian Ximing, who's shorting the market, not because he hates silver, but because he loves gold. We've seen the physical floor created by Turkey, a nation that bought 8.79 million ounces in a single month while you were panicking. And we've warned you about the lunar trap next week where thin liquidity could test your resolve one last time. Now, let me give you the conclusion. The conclusion is crystal clear. The crash to 80 was a fake out. It was driven by one billionaire's speculative bet and a temporary panic over Kevin Warsh. It was not a change in fundamentals. In fact, the fundamentals have never been stronger. Physical demand is at a record high. The Turks are buying everything. The Indians are buying. Smart money is accumulating. Supply is restricted. China locked down exports. The mines are struggling. The vaults are bleeding. Price is manipulated. It's being suppressed by paper shorts that have no physical backing. So do not be fooled by the volatility next week. If you see silver drift down to 72 during the lunar holiday, realize what it is. It's a gift. It's a chance to buy an asset that's mathematically destined for 3 digits at a discount created by an algorithm. The floor is in. The physical buyers are defending 80 like their lives depend on it, because financially, they do. The whale is trapped, and the squeeze is coming. Let me explain why BN's position is a ticking time bomb. He's short 30,000 contracts. That's 450 tons. Turkey just bought 273 tons in 1 month, half his position in physical bars. If Turkey keeps buying at this pace, they'll absorb his entire short position in 2 months, and he can't deliver physical. He doesn't have it. So when his margin call comes, and it will come if price hits 86, he'll be forced to buy. 30,000 contracts in a market with no metal. Think about what that does to price. Every contract he covers pushes price higher, which triggers more margin calls, which forces more buying. It's a doom loop, the classic short squeeze setup. And he's not just fighting retail, he's fighting sovereign nations. He's fighting Turkey, which is treating every dip as a strategic accumulation opportunity. He's fighting a global physical shortage that's getting worse every day. He's fighting the math, and math always wins. Do your own due diligence, understand the risks. This is not financial advice. But based on everything I've shown you, here's my take. The crash to 80 wasn't real. It was paper manipulation colliding with sovereign buying. The floor is concrete. Turkey proved it with 8.79 million ounces in January. The whale is trapped. BN can't cover without spiking price. And the Fed revaluation thesis makes $12,000 gold not just possible, but necessary. When you combine all of this, physical shortage, record demand, trapped shorts, Fed insolvency, Chinese export controls, the setup is asymmetric. Downside is limited by physical buyers defending the floor. Upside is unlimited because the shorts have to cover eventually. And when they do, the move will be violent. So what should you do? If you own physical silver, hold it. Do not sell into weakness created by holiday algorithms. If you're thinking about buying, next week might give you one last gift. If they flush it to 70 or 68 during the lunar holiday, that's your entry. But if 80 holds without Asian support, the game is over. The bears are dead. And the next move is vertical. Watch 72, that's the line. If it breaks, we test 68. If it holds, we retest 86 by month end. Either way, the fundamentals haven't changed. The physical market is tightening. The paper market is bleeding. And eventually, always eventually, physical reality wins. Drop your take in the comments. Are you buying the lunar dip or waiting for confirmation? This is Mark from GoFinance. The floor is in. The whale is trapped. The squeeze is coming. Stay sharp.